Gold has always carried a certain mythology. For centuries, it symbolized wealth, power, and permanence, a timeless refuge when paper currencies failed or governments collapsed. People have trusted it through wars, depressions, and revolutions. It's deeply ingrained in our psychology as something real, something tangible that can't be printed or erased by a government decision. But the truth is that the world has changed profoundly. The economic system that supported gold's dominance is no longer the same. The mechanisms of value, risk, and trust have evolved, and gold's traditional role as a hedge is becoming less reliable in the context of our modern financial architecture. To understand this transformation, we need to step back and look at how the structure of money and markets has shifted. In the past, when gold was tied to currencies, it served as the anchor of the financial system. The amount of money that could be printed was limited by how much gold a nation had in its reserves. That link created stability, but it also created rigidity. Economies couldn't easily respond to crises or adapt to changes in trade and productivity. When the U.S. abandoned the gold standard in 1971, it opened the door to a new era, one defined by flexibility in monetary policy, but also vulnerability to debt cycles, inflation, and human error. Since then, the world has moved through multiple major debt and inflation cycles, and gold has performed differently in each one. But in 2025, we're no longer in a world where gold automatically rises with uncertainty or inflation. The dynamics have shifted. The first major change is the structure of money itself. We now live in a world of digital liquidity. Capital flows across borders at the speed of light, and central banks can create or absorb trillions with a few keystrokes. Monetary systems have become data-driven, dynamic, and globally interconnected. In such a system, gold, a static, non-yielding asset, struggles to compete with instruments that are programmable, yield-bearing, and liquid. Investors today can hedge inflation using inflation-linked bonds, derivatives, or even algorithmic strategies that adapt to changing market conditions. The store of value function that gold once had has been replicated, and in many ways improved by the evolution of financial engineering. The second change is the role of trust. Historically, people held gold because they didn't trust governments or paper currencies. That's still true to some extent, but the nature of trust has evolved. Today, trust is distributed. It's built on transparency, technology, and diversification rather than a single commodity. For instance, blockchain technology and digital currencies have created new systems where value can be stored, verified, and transferred without the need for physical metals. Whether it's central bank digital currencies or decentralized systems, the future of money is becoming programmable and auditable, characteristics that gold can't offer. That doesn't mean digital assets have replaced gold entirely, but it does mean the psychological need for gold as a safe have and store of value is eroding. Another important aspect is the changing relationship between inflation, interest rates, and growth. Historically, gold has thrived in environments of negative real interest rates when inflation outpaces returns on cash and bonds. But in 2025, most major economies are experiencing moderating inflation and higher real yields. Central banks have learned from the past few years of inflationary pressure, and they're keeping policy tighter for longer to maintain credibility. When investors can earn 45% real returns on short-term instruments with minimal risk, gold's opportunity cost rises. You can think of it this way: holding gold is effectively earning a zero yield. In a world of higher real rates, zero yield becomes expensive. That's why, even with geopolitical risks and market uncertainty, gold prices are struggling to break meaningfully higher. The macro backdrop is fundamentally unfavorable. The global interconnectedness of financial systems also means that gold no longer responds to crises the way it used to. In the past, a regional crisis could trigger massive inflows into gold as investors fled local currencies. Now, global liquidity and risk management tools allow capital to shift between asset classes more fluidly. Investors can hedge with volatility indexes, commodities, or even synthetic exposures through ETFs and futures markets. The emotional impulse to buy gold when fear rises has been partially replaced by algorithmic decision making and diversified portfolio construction. As a result, gold's reaction to global stress has become weaker and shorter-lived. Moreover, the economic power structure of the world is different. In previous decades, gold was heavily influenced by Western monetary policy, particularly the US dollar. Today, we're seeing a multipolar world where China, India, and other emerging economies play larger roles in trade, energy, and reserves. While some of these countries are increasing gold holdings as a form of diversification, their broader investment strategies are focused on tangible productivity, industrial expansion, technology, and infrastructure. The modern economy's wealth creation is increasingly driven by innovation, data, and intellectual capital, not the accumulation of physical metals. Investors who align with that reality position themselves for long-term growth, while those clinging to the old gold narrative risk underperformance. We should also consider the psychological bias that surrounds gold. People often mistake its historical prestige for present-day utility. They see the metal as eternal and incorruptible, and therefore safe. But safety in investing is relative. It's about how well an asset performs across different cycles. Gold doesn't collapse in value, but it also doesn't compound wealth. It protects purchasing power over centuries, not over investment horizons of 5 or 10 years. That distinction is critical. In modern investing, compounding matters. Wealth grows from reinvested returns, innovation, and adaptability, not from static preservation. In a world where capital efficiency determines success, holding too much gold can actually be a form of regression, a decision based on fear rather than rational analysis. Let's also touch on the new forms of systemic risk. When people fear inflation, they turn to gold. When they fear deflation, they turn to cash. But what we face today isn't a simple inflation-deflation cycle. It's technological disruption, political fragmentation, and climate transition. These are complex, nonlinear risks that require diversified, adaptive strategies. Gold doesn't solve these. A portfolio designed to handle modern uncertainty must blend productive assets, like equities and infrastructure, defensive assets like bonds and cash equivalents, and non-correlated alternatives, like commodities or certain hedge strategies. Gold can be part of that mix, but its importance is far smaller than it once was. Finally, we can't ignore the shift in generational behavior. Younger investors are more comfortable with digital ecosystems, real-time data, and algorithmic decision-making. They don't see gold as a symbol of security. They see it as outdated. As these generations take greater control of global capital, market psychology itself changes. Demand patterns shift from physical stores of value to digital instruments of yield and transparency. That's not a temporary trend. It's a structural evolution. When you put all this together, gold's position in the modern financial system looks less like a cornerstone and more like a relic, valuable but limited. It still serves a purpose as a minor hedge or a symbolic form of diversification, but it's no longer the dominant safe haven that traditional investors believe it to be. The world has outgrown the conditions that made gold indispensable. Our financial systems, driven by data, innovation, and rapid adaptation, now reward flexibility and productivity, not static preservation. In essence, gold hasn't changed, but the world around it has, and when the environment changes, the meaning of safety changes too. The current macroeconomic environment is a complex and transitional one, and to understand why gold is not performing as expected, we need to dissect the underlying forces that are shaping asset returns today. Every investment exists within a framework of cycles: debt cycles, business cycles, inflation cycles, and even confidence cycles. Gold, like all other assets, responds to these forces. It doesn't exist in isolation. The reason gold thrived in certain periods and struggled in others is not random. It's the direct result of how liquidity, interest rates, and real returns move through time. In 2025, those forces are aligning in a way that is fundamentally unfavorable for gold investors. The first element to understand is the behavior of real interest rates. Real rates represent the true cost of money, what you earn after adjusting for inflation. When real rates are negative, investors lose purchasing power by holding cash or bonds, and they naturally gravitate toward assets that are perceived to protect value, such as gold. But when real rates rise, that dynamic reverses. Investors are compensated for holding safer assets. They can earn positive real returns without taking on market risk. In that kind of environment, gold, which yields nothing, becomes less attractive. It's a simple but powerful relationship. Gold's opportunity cost moves in direct correlation with real yields. Over the last 2 years, central banks around the world have shifted from expansionary to contractionary monetary policy. They are no longer flooding markets with liquidity as they did during the pandemic. Instead, they're draining it to contain inflation and rebuild credibility. This tightening cycle has created an environment where cash and short-term bonds provide meaningful yields. For the first time in over a decade, investors are earning real income simply by holding safe instruments. As that happens, capital naturally flows out of non-yielding stores of value, gold being the most prominent one, and into assets that generate steady, risk-adjusted returns. This liquidity tightening affects all markets, but it hits gold especially hard because gold's strength relies heavily on excess liquidity and inflation expectations. When central banks inject liquidity, they lower real rates and debase currencies, which fuels demand for gold. But when they reverse course, the tide that once lifted gold begins to pull it down. The psychology shifts from fear of currency debasement to confidence in policy control. Investors move from defensive to opportunistic positioning. Gold's allure fades, not because it loses intrinsic value, but because the economic incentives that once supported it are gone. The relationship between inflation and gold has also evolved. Many still assume that inflation automatically boosts gold prices, but that's a partial truth. It's not the level of inflation that matters most. It's the direction and the expectations around it. Gold performs best when inflation is rising faster than expected, catching policymakers and investors off guard. Once inflation stabilizes or begins to fall and markets start to anticipate policy normalization, gold loses momentum. In 2025, inflation is no longer accelerating. It's declining from its post-pandemic peaks as supply chains recover, energy prices stabilize, and wage pressures cool. That shift in trajectory has removed one of the biggest tailwinds that supported gold during the 2020-2022 period. Then there's the US dollar, still the dominant global reserve currency. The inverse relationship between the dollar and gold is well known but often misunderstood. When the dollar strengthens, it tightens financial conditions globally because commodities are priced in dollars. That means gold becomes more expensive for non-dollar investors, suppressing demand. A strong dollar also signals relative economic resilience and confidence in U.S. monetary policy, both of which reduce the need for defensive hedges. like gold. As we move through 2025, the dollar remains strong due to higher interest rates, global capital inflows, and relatively stable U.S. growth compared to other regions. This is another structural headwind that makes it difficult for gold to sustain upward momentum. We also have to consider how global capital flows are being restructured. After years of loose monetary policy, we're seeing the world adjust to the end of free money. Debt servicing costs have risen, investment capital has become more selective, and risk premiums are being reassessed. In this new environment, the demand for yield and productivity is dominating investor behavior. Gold, by its nature, does not produce cash flow, innovation, or earnings. It's a static asset, valuable in preservation, not in creation. As a result, in a world that rewards productivity and efficiency, gold lags behind assets tied to economic growth or technological advancement. At the same time, the tightening of global liquidity is reshaping the behavior of institutional investors and sovereign funds. Central banks, hedge funds, and large asset managers are optimizing their portfolios for resilience, but also for income. When you can earn 5% or more on U.S. Treasuries with virtually zero risk, gold's relative appeal diminishes sharply. That's not speculation. That's rational capital allocation. Money always flows where it's treated best, and right now, yield-bearing assets are offering better treatment than inert metals. There's also the factor of velocity, how fast money moves through the system. When liquidity is abundant, the velocity of money increases, speculation rises, and assets like gold benefit from that excess. But in a tightening phase, liquidity slows down. Financial markets become more selective, and capital rotation becomes more deliberate. This slower circulation of money compresses speculative premiums across all asset classes, including gold. What we're witnessing now is a return to fundamentals, an environment where tangible productivity, profitability, and income generation matter more than defensive symbolism. Now, let's not ignore the behavioral side of investing. Gold has always been driven as much by emotion as by logic. It thrives on fear of inflation, fear of debt crisis, fear of currency collapse. But in 2025, despite geopolitical tensions, most economies are managing to stay functional. Markets are adjusting to policy shifts and inflation, while elevated compared to the pre-pandemic decade, is no longer chaotic. That means fear is being replaced by cautious optimism. Investors are not fleeing the system, they're rebalancing within it. As that psychology shifts, gold's emotional premium, the part of its price that's driven by anxiety rather than fundamentals, begins to erode. One of the most overlooked realities about gold is that its long-term performance, when adjusted for inflation, is not impressive. Over decades, gold protects purchasing power, but it doesn't grow wealth. In contrast, equities and real assets tied to productivity have historically outperformed because they participate in human progress. During periods of economic tightening, the gap between productive and non-productive assets widens even more. That's exactly the phase we're in right now, where efficiency, yield, and adaptability define winners and losers in the investment landscape. This doesn't mean gold is useless. It still has a role as a minor hedge, a component in a well-diversified portfolio that balances against tail risks. But its role has to be proportional to its actual function, not inflated by nostalgia or emotion. In today's environment, where real yields are positive, liquidity is tightening, and inflation expectations are stabilizing, that role is relatively small. Allocating too heavily to gold is effectively a bet against the productivity of the world. And that's not a bet that pays off over time. When you connect all these dots, it becomes clear that gold's current weakness isn't temporary, it's structural. It's the natural outcome of a macro environment that rewards cash flow, punishes speculation, and demands efficiency. The same factors that once fueled gold's rally, cheap money, falling real yields, inflation fear, are now reversed. Markets are disciplined again. Central banks are cautious. Investors are rationalizing risk. In that world, gold's old narrative doesn't fit. The bigger picture here is that we're witnessing a transition between economic phases, from monetary inflation to productivity-driven rebalancing. Whenever that happens in history, gold tends to underperform. The pattern is consistent. When liquidity shrinks, real yields rise, and confidence stabilizes, gold retreats. It's not manipulation. It's not mystery. It's simply how the cycle works. And understanding that cycle, rather than reacting emotionally to headlines, is what separates disciplined investors from impulsive ones. One of the most common mistakes investors make is confusing historical reputation with present-day utility. Gold has a powerful reputation. It has been money, protection, and prestige for thousands of years. That legacy carries emotional weight. But when you strip away that emotion and analyze gold in today's context, through the lens of how the global economy actually works, the picture changes. What we see is that many investors are holding on to gold, not because it's strategically optimal, but because it feels familiar. They're investing based on nostalgia, not logic, and nostalgia is not a strategy. Every asset has a role in a portfolio, a job it performs under certain conditions. Bonds provide stability and income. Equities offer growth and participation in productivity. Commodities hedge inflation. Cash provides liquidity and optionality. Gold historically filled the role of protection, insurance against paper money losing value. But today, the economic ecosystem has evolved. There are more tools, more mechanisms, and more sophisticated ways to protect wealth than ever before. Clinging to gold as the ultimate hedge ignores these developments. It's like using an old map to navigate a new world. The biggest misconception is that gold automatically protects against inflation or currency debasement. That was true in the era when gold and money were directly connected, when devaluing a currency meant increasing its gold price. But since the global monetary system went fully fiat, the relationship between inflation and gold has become indirect, complex, and inconsistent. Gold reacts not to inflation itself, but to the perception that inflation is out of control or that policymakers are losing credibility. When central banks act decisively to manage inflation, even if inflation is high, gold can stagnate or fall. The idea that inflation equals gold up is an oversimplification, a comforting story that doesn't match reality. The same applies to the concept of safety. Gold is often marketed as a safe haven, but safety in financial terms is not about avoiding volatility. It's about managing risk relative to reward. Gold may not collapse, but it also doesn't compound over time. Safety without growth is erosion. Holding gold for decades may preserve purchasing power, but it doesn't build wealth. The opportunity cost of doing nothing with capital, of holding a non-productive asset, compounds negatively when compared to reinvested earnings, dividends, or innovation-driven returns. In a world where innovation drives real economic progress, sitting still is equivalent to moving backward. This is where many investors fall into what I call the illusion of security. They see gold's stability as a form of safety, but they ignore the cost of that stability. If your wealth isn't growing at least as fast as productivity and inflation, you're quietly losing ground. Gold doesn't generate income, doesn't improve efficiency, and doesn't benefit from technological progress. It just sits there. It's static value in a dynamic world. And the modern economy rewards adaptability, not immobility. The misunderstanding deepens because investors often look at short-term events like a crisis, war, or policy misstep and assume those automatically justify buying gold. But when we study history, we find that even during crises, gold's performance depends on broader context. During the 2008 financial crisis, for instance, gold rose initially as fear spiked, but then fell sharply as liquidity dried up and investors sold whatever they could to raise cash. The same pattern repeated in early 2020. Gold rose in the panic phase, then dropped as liquidity constraints hit, and later recovered when central banks flooded the system with money. The point is, gold doesn't respond directly to crisis. It responds to liquidity conditions and policy reactions. Many investors misunderstand this cause and effect chain, and as a result, they buy gold for the wrong reasons at the wrong times. Another misconception is the idea that central bank buying of gold automatically signals opportunity. Yes, some central banks, especially in emerging markets, are diversifying reserves by accumulating gold. But that behavior has strategic, not profit-driven, motives. Central banks buy gold to reduce dependence on the US dollar and to hedge geopolitical risk, not to generate returns. For an individual investor, copying that behavior without understanding its rationale is misguided. It's like imitating the moves of a chess grandmaster without understanding the position on the board. You might feel clever, but you're still playing blindly. The truth is that the role of gold in a modern portfolio should be small and strategic, not emotional and dominant. Gold can still be valuable as a partial hedge, a small percentage of exposure to balance extreme scenarios such as currency devaluation or systemic shocks. But beyond that, overexposure becomes counterproductive. The problem is that most investors don't think in terms of balance. They think in terms of absolutes. They want a single answer, a single asset that guarantees protection. But markets don't work that way. Reality is dynamic. What protects you in one phase of the cycle can hurt you in another. That's why I've always emphasized diversification by risk, not by name. Gold is just one small part of that equation, not the equation itself. What we're seeing today is that investors are missing the shift in how value is created. The modern economy is increasingly driven by intangibles, data, technology, intellectual capital, networks. These forces create exponential growth in assets that can adapt and compound. Gold, being static, doesn't participate in that growth. The more global productivity expands through innovation, the more gold falls behind in relative performance. Over time, this compounds into a massive gap in returns. The difference between owning productive assets and non-productive ones becomes the difference between building wealth and merely preserving it. Another key misunderstanding is about volatility and resilience. Many investors think gold is less volatile and therefore safer. But volatility is not inherently bad. Volatility in a productive asset can create opportunity. It can be managed, rebalanced, and used to generate returns. Gold's low volatility simply means low dynamism. It doesn't respond to changing fundamentals. It's like a constant in an equation that no longer represents the variables of the modern economy. Resilience in today's markets comes not from being static, but from being balanced, holding assets that perform in different environments and adjusting as the cycles evolve. It's also worth noting that the new generation of investors sees gold differently. The psychological attachment to physical metal is largely generational. Younger investors are more comfortable with digital systems, algorithmic models, and tokenized assets. They trust data more than they trust metal. That doesn't mean digital assets are inherently superior. It means the center of gravity in global trust has shifted. Gold is no longer the default language of safety. That shift in perception matters because in markets, Perception drives demand, and demand drives price. As generational wealth transfers continue, this evolving psychology will reduce gold's long-term role in portfolios even further. When we look at all these factors together, we can see a pattern. Gold is being misunderstood because many investors are stuck in an old paradigm, a world where the economy was simple, policy was slow, and trust was fragile. But today, policy moves fast, information is instant, and diversification tools are abundant. The defensive power of gold has been diluted not because it lost its essence, but because the system evolved beyond it. The world has more sophisticated and flexible ways to manage uncertainty now. Investors who cling to gold as the cornerstone of safety are, in effect, anchoring themselves to a past version of the economy. A wise investor adapts. They ask not what worked before, but what works now. The evidence is clear in 2025. Gold's performance, correlation, and role have all shifted. It no longer provides the same asymmetric protection it once did. It's a sentimental asset in a rational market. And that's dangerous because emotion-driven investing always ends the same way: disappointment. The real lesson here isn't about gold itself. It's about perspective. When conditions change, strategies must change. Holding on to outdated beliefs because they once worked is the fastest way to fall behind. Gold may still shine, but it no longer leads. The future belongs to investors who understand cycles, embrace diversification, and allocate capital based on principles, not nostalgia. The world rewards clarity, adaptability, and balance, not attachment to the past. To understand why gold's current value is more psychological than practical, we must start with the cycles that drive the global economy. Everything in markets, from the price of money to the behavior of investors, follows patterns that repeat over time. These patterns aren't identical, but they rhyme. They're shaped by human nature, by policy reactions, and by the flow of credit. When you look deeply into these cycles, the long-term debt cycle, the short-term business cycle, and the geopolitical cycle, you begin to see why gold, at this particular point in history, doesn't offer the protection or reward it once did. Its strength lies more in sentiment than in structure. The long-term debt cycle is the foundation of modern economic dynamics. Over time, economies accumulate debt faster than income grows. That's because borrowing creates spending power today in exchange for repayment tomorrow. This process fuels growth and asset appreciation, but eventually the debt burden becomes too large relative to income. When that happens, economies enter deleveraging phases, periods when debt must be reduced either through austerity, restructuring, or inflation. Historically, these periods were when gold performed best because people lost confidence in paper assets and sought something tangible. But the current phase of the global debt cycle is different. After decades of expansion, the world is now in the late stage of a debt supercycle, but policymakers have far more tools to manage it than before. Instead of defaulting or relying solely on inflation, central banks are using quantitative tightening, controlled interest rate adjustments, and financial regulation to gradually reduce excess leverage. This controlled tightening means the system isn't collapsing, it's rebalancing. In such an environment, fear, the main psychological driver of gold demand, is not dominant. Investors don't see the need to rush into gold because the deleveraging process, while painful, is being managed. The absence of panic keeps gold's demand limited. In earlier cycles, such as in the 1970s or during the Great Depression, the lack of monetary flexibility had made gold indispensable. Today, flexibility itself has become the new safety valve. The short-term business cycle adds another layer of understanding. It moves in roughly 5 to 10-year waves of expansion and contraction driven by credit availability. When credit expands, spending rises, and asset prices increase. When it contracts, growth slows, and liquidity tightens. Gold tends to perform well during the contraction phase when real rates are falling, currencies weaken, and fear dominates. But in the current cycle, we're in a phase where growth is slowing but still positive, and real interest rates remain high. This combination is unusual but important. It means that while liquidity is tightening, inflation expectations are stable. Under those conditions, gold's traditional trigger, panic over uncontrolled inflation or deflation, isn't being pulled. The system is cooling, not collapsing. The third cycle, the geopolitical one, influences everything else. Shifts in power, trade, and alliances change the flow of money and trust across nations. Throughout history, the rise and fall of empires have affected what people consider safe. When global order weakens, gold gains psychological appeal because it feels like neutrality. It's no one's liability. But when global power transitions are managed through institutions and diplomacy rather than war or collapse, gold's role weakens. Right now, we are in the middle of a geopolitical transition from a US-dominated unipolar world to a more multipolar system with China, India, and other regions asserting greater influence. This transition is tense but not chaotic. The global economy is adjusting, not disintegrating. That means gold's geopolitical premium, the portion of its value derived from fear of breakdown, is limited. When you put all three cycles together, debt, business, and geopolitical, you can see that we are in a phase of adjustment, not destruction, and that's crucial. Gold thrives on destruction, not adaptation. It rises when people lose faith in the system, when money itself is in question. But right now, even with political noise and policy shifts, the core of the system remains intact. Central banks, governments, and markets are still functioning imperfectly, but functionally. Confidence hasn't evaporated, it's evolved. Investors no longer rely on gold as their primary anchor of trust. They rely on diversification, liquidity, and policy responsiveness. The mechanisms of stability have changed, and gold hasn't adapted. This brings us to the psychological dimension. Gold's value today is sustained largely by belief in its timelessness, its purity, its safety. That belief is deeply ingrained in human culture and finance. But belief alone doesn't generate returns. It sustains demand, but it doesn't create productivity. In behavioral finance, we call this anchoring bias, the tendency to rely too heavily on past experiences when making decisions about the future. Investors anchored to the memory of gold's historical performance project that passed into the present. Even when the underlying conditions have changed, they see gold's history as proof of its future without recognizing that the forces driving its historical performance, inflationary shocks, monetary rigidity, and war, are not the dominant forces today. The irony is that this psychological faith in gold can make it appear strong for short periods, especially during market uncertainty, but it's not driven by fundamentals. It's self-reinforcing sentiment. When fear rises, people buy gold because they expect others to buy gold. That herd behavior can create temporary spikes, but without sustained fundamental support, such as declining real rates or runaway inflation, those rallies fade. What we've seen over the past 2 years is a perfect example of this. Gold has tested new highs but failed to hold them because those highs were built on emotion, not on real macroeconomic shifts. If we analyze gold from a systems perspective, we see that its utility as an anchor asset is declining precisely because the system itself is becoming more adaptive. The modern economy is data-driven, interconnected, and constantly adjusting. Central banks don't wait for crises to react anymore. So they preemptively manage liquidity and credit. That's why, even in moments of stress, the global financial system doesn't unravel the way it did in the past. The result is that gold's traditional role as the ultimate fallback is less relevant. The world has created new backstops, monetary coordination, swap lines, digital reserves, and automated liquidity mechanisms. These act as systemic gold, invisible, flexible, and far more responsive. That doesn't mean gold is worthless. It still plays a role in diversification, particularly for hedging long-term tail risks that can't be quantified. But it's not the primary form of protection anymore. Relying on gold today as a core defensive strategy is like relying on a sailboat in an era of airplane. It still works under certain conditions, but it's not the most efficient or practical tool available. Investors who understand cycles recognize that timing and context matter more than tradition. Holding gold when the system is stabilizing is fundamentally different from holding it when the system is collapsing. In 2025, the global economy is not collapsing, it's evolving. We're witnessing structural adjustments, higher real rates, slower growth, technological disruption, and geopolitical balancing. Those forces favor assets tied to productivity and innovation, not static stores of value. The discipline of investing requires aligning strategy with reality, not sentiment. What separates good investors from average ones is the ability to see beyond emotion, to understand that safety is not about clinging to the past, but adapting to the present. Gold for many represents emotional safety, but real safety comes from knowledge, balance, and diversification across cycles. When you understand the long-term debt cycle, you prepare for deleveraging. When you understand the short-term business cycle, you adjust for liquidity. When you understand the geopolitical cycle, you position for transition. Those insights offer far greater protection than any metal ever could. The conclusion is clear. Gold's value today is primarily psychological, a reflection of human memory and fear. Its practical value, in terms of real returns and economic function, has diminished. As the global system grows more complex and self-correcting, investors who adapt to this reality will thrive. Those who hold on to gold out of nostalgia will simply be paying for comfort, not for performance. When we step back and look at everything discussed, the economic cycles, the structural transformations, the evolution of money, and the psychology behind investment behavior, it becomes evident that gold's position in the global financial system is changing, not disappearing, but transforming. Gold was once the foundation of trust, the anchor of value, and the fallback in times of uncertainty. But in today's world, the very meaning of trust and value has evolved. The system that once depended on static anchors now depends on dynamic adaptability. That's the fundamental shift investors must understand. Gold historically thrived in times of instability. When fiat currencies were collapsing, when inflation was spiraling out of control, or when governments were losing credibility. But today, the global system, despite its challenges, is far more sophisticated. Central banks are no longer rigid institutions reacting too late. They are proactive, data-driven entities equipped with powerful tools, liquidity controls, quantitative easing, and monetary coordination that stabilize the global economy even during stress. That doesn't mean crises won't happen, but it means they unfold differently now. They're managed, not catastrophic, and when the system learns to manage instability, gold loses its traditional purpose. In previous cycles, gold represented protection against uncertainty because it was the only form of value not tied to human promises. But today, new forms of protection have emerged. Diversification, data, transparency, and technology-driven liquidity. These innovations have replaced emotional safety with structural resilience. Gold's value used to come from being outside the system. Today, the system itself has evolved to integrate safety. That's why investors who still look at gold as the ultimate hedge are not wrong, but they are outdated in their understanding of how the world now functions. The truth is that every asset has its moment, its ideal point in the cycle where it provides maximum advantage. Gold's moment was in the era of monetary rigidity and global mistrust. But in the current stage of the long-term debt cycle, when governments are adjusting rather than collapsing, when inflation is moderate, and when capital is flowing toward productivity rather than preservation, gold is not positioned to outperform. It is stable, but stability without growth is stagnation. Investors must distinguish between assets that preserve wealth and assets that create it. In 2025, gold preserves sentiment, not purchasing power. Another point often overlooked is the changing psychology of global investors. Younger generations entering the financial world no longer see gold as the ultimate symbol of safety. They see it as a relic of an older financial order. For them, safety means liquidity, diversification, and adaptability. They value systems that respond quickly, digital platforms, decentralized finance, real-time transparency. In a world where the speed of information defines the value of assets, gold's immobility becomes its weakness. It doesn't move fast enough to reflect or respond to new realities. That's not a flaw in gold itself. It's a reflection of a changing world. Now, it's as essential to remember that gold still has symbolic and psychological value. It represents stability in a world that often feels unstable. But investors must not confuse symbolism with performance. Holding gold in small amounts can serve as a hedge against extreme tail risks, those rare, unpredictable shocks that defy the system's adaptability. But holding large allocations out of fear or nostalgia is not strategy. It's emotion disguised as prudence. The market punishes emotion. It rewards awareness. If you look closely at how capital moves today, it's clear that the focus has shifted from what is safe to what adapts. Capital flows to assets that generate cash flow, that innovate, that integrate with technological and geopolitical shifts. Productivity is the new safety. In a high-rate data-rich, globally connected environment, assets that produce value. Businesses, infrastructure, technologies, and even adaptive currencies will outperform assets that simply exist. Gold exists, it doesn't evolve. And in a world of evolution, stillness is risk. The broader implication here is that investors must think in terms of cycles and systems, not moments and emotions. The long-term debt cycle is approaching a mature phase. The short-term business cycle is adjusting after years of excess liquidity, and the geopolitical cycle is redefining alliances and power structures without collapsing them. In all these cycles, we see movement, not breakdown. That's why gold is not the answer right now. The system is healing, not falling apart. And when systems heal, liquidity and innovation outperform rigidity and nostalgia. It's also worth noting that gold's value at this point is heavily sentiment-driven. Its price reacts less to fundamental shifts and more to emotional waves. Fear of inflation, fear of war, fear of uncertainty. But in most cases, these fears fade faster than fundamentals change. That creates volatility without reward. The disciplined investor learns to see through that noise. The disciplined investor asks, is this asset aligned with where the world is going or with where the world used to be? In the case of gold, the answer is clear. It represents where we've been, not where we're heading. As we move deeper into the decade, the real challenge for investors will not be to predict the next crisis, but to understand how systems adapt to crisis. Those who understand adaptation will recognize that gold's reliability as a hedge is diminishing precisely because the mechanisms that once made it essential have been replaced. Digital currencies, adaptive monetary policy, and cross-border liquidity frameworks are the new tools of protection. The very role that gold played in the 20th century is now being played by diversified, technology-enabled systems in the 21st. In summary, gold is not bad. It's just out of phase. It's not the enemy of wealth, but it's no longer the shield it once was. Its purpose was to protect in times when trust was scarce and information was slow. But today, trust is algorithmic and information moves at the speed of light. The investor of the future doesn't hide from volatility, they navigate it. They don't seek absolute safety, they seek adaptive balance. That is the new discipline of wealth building. So, if you're asking whether you should hold gold in 2025, the answer depends on what you're protecting against. If it's fear, gold will comfort you. If it's uncertainty, diversification will protect you. But if it's stagnation you wish to avoid, then gold is not your ally. Real safety today lies in understanding cycles, anticipating transitions, and staying liquid, informed, and adaptable. The most successful investors aren't those who predict the future perfectly. They're the ones who align themselves with how the future evolves. The future is moving fast, it's data-driven, it's adaptive, and it rewards productivity. Gold, for all its beauty and history, cannot keep up with that pace. Its shine remains, but its power fades. And in the end, investing is not about holding what once worked, it's about positioning yourself for what works next. That's the real gold of the modern age.